Hey everybody, how is it going? Today is Saturday, January 14th, 2023, and welcome to the weekend edition of the Gossett Trading and Mentoring Podcast. In this podcast, what we're going to do, the format for today, first of all, we are going to go ahead and we are going to run the US legal disclaimer, get that out of the way. Secondly, we are going to come back. We're going to take a look at all the trades that I made this week, when I bought them, when I bought the position, why I bought the position, and most importantly, how I am going to manage it going forward. As you know, if you've been listening to this podcast, I do like to trade multiple time frames, daily time frames, weekly time frames, monthly time frames. I day trade all during the day. On the intraday time frames, I like to trade as many different markets as possible, and I like to trade as many different strategies as possible. I feel like it smooths out your equity, smooths out your risk and your returns. I think I've been trading for 28 years, and I believe it is a big part of my success with the three pillars of trading. Again, trade as many different time frames as possible, as many different strategies as possible, and as many different uncorrelated markets as possible as well. Hope you're doing well. Boy, we had a great day or a great week last week in the markets. We finally rallied. Seemed like it was never going to happen, but we did. So I hope you were able to participate in that. And after we go through my positions, we're going to do a little bit on trader psychology. We're going to do a poem for my good friend Frank, who is the trading poet. And then I have gone down through my watch list, my master watch list, both on the daily and the weekly time frames. And I have identified some potential trades for next week, what I'm looking for. So hopefully this podcast is helpful for you. Hopefully it shows you a little bit about how I take a look at trades and setups, look for multiple confluences, combinations of indicators, position size, based upon the current market volatility, looking for in each trade, we are always going to have our emergency stop. We're going to have our end of day stop. We're going to take profits during the day. Whenever the market gives us something, I want to take a partial profit. If the market is kind enough to give us a little something, I want to take a little something so I can lock that in. We're going to look for significant overhead resistance levels. We're going to have trailing stops in place. And this is interesting. I mean, we'll get to it in a minute, but we have some stocks that are up near the 70 RSI levels. I haven't talked about a 70 RSI level, it seems like, in months. So maybe some things are changing. Hopefully they are. So anyway, that's what we're going to do. Let's go ahead and run the US legal disclaimer first. I'll be back in about 40 seconds and we will get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, here we go. Let's get started. First of all, MasterCard. Boy, this is such a great example of consolidation leading to trends. And, if you've listened to this podcast, you've heard me say this many times, consolidation, or in other words, sideways motion, compression of price, sideways motion, eventually leads to a trend. Either the trend is up, and if we're on the right side of that, we have a process of taking profits. We have trailing stop process. If we're wrong, then we get out quickly. It could trend downwards as well, right? But if we're wrong, we get out quickly. So I did buy this MasterCard MA back on December 20th when we came down and we had a bounce at the 250 and the 300 simple moving average. These are levels of support. And when I see a rejection of a level of support, like the 300, the 250, the 200, the 30 RSI, well, that's where I know support is. That's where I know, at least for the time being, that price or that level has been rejected by sellers. There were no more sellers. And if you run out of sellers, well, the implication is that the market's going to go up. Now, it doesn't always work that way, but that's the only thing I can go from, right? Looking at support levels, looking for rejection, position sizing based upon the current market volatility. And if I'm wrong, in a big way, I have an emergency stop. This is my emergency stop all the way down here, 327. But my end of day stop is a close below the support level that I took the trade from. So I did take the trade all the way back here on the 20th. I took it at 342.70. I took my maximum allowed loss, which is generally 1% of my trading capital. I divide it by the value of the 2 ATR that shows me how many shares to buy. Then I placed my emergency stop exactly the 2 ATRs below that at the time that I bought it, so that if it does get down there, well, then I've lost what I was okay with losing. Let's just take an example here. 1%. Let's just say we have a $100,000 trading account. So 1% of 100,000 would be $1,000. I would divide it by the value of the 2 ATR, divide it by 14.94. That's going to tell me to buy 66.9 shares, or in other words, I'd have to round up to 67 shares. Now, with 67 shares does move $14.94, well, then I've lost my $1,000. See how that works? Now, it's not always $1,000. If you have a $25,000 trading account, 1% of that would be 250. Then you divide 250 by 14.94, and it would give you 1/4 of what this is. So it's very important. Worst case scenario, if it had gotten down here, I would have lost that hypothetical $1,000. Now, that's the emergency stop. The end of day stop would simply have been a close below the level that it rejected. Well, here it is, about 339.87. Well, the next day it went up, took a little profits. Now I always take 10% of the remaining shares that I have if it moves the value of 0.45 ATRs from the previous day's close. Well, I did take off 10% here, right? And then the next day it went below my end of day stop. If it had simply closed below here, I would have just gotten out for a small loss, but it didn't. And that's why I wait until the end of the day to make my trading decisions, because at the end of the day, the large financial institutions make a lot of decisions in that last hour, and in particular in the last few minutes, and I consider them to be the smartest money on the street. Therefore, I'm waiting till the end of the day. Now, if it got down here to my emergency stop, then I get out immediately. I don't care if it's 1 minute after the market closes or 1 minute before the market opens. I do not wait for the end of the day, because it could just keep going down. But for my end of day stops, I wait for the end of the day. And you can see here on the 22nd, it went way below my level, but then closed above. So I stayed in the trade. The next day, opened below, closed back above. Right? So as long as it stays above that end of day stop, I'm going to stay in the market. And then as it moves up, I took some profits here. I took some I took some partial profits here. I took some partial profits here. I hit 3 profit targets on this day. I hit 2 profit targets on this day, 2 profit targets here. And so again, as it moves up, I want to start taking partial profits. Now, you don't have to do this. I don't have to do this, but I really, I've been trading for 28 years, and I really enjoy this, because it's never fun when you have a big move up and then it comes back down and you give it all away. So I do take partial profits. Now, I did exit half of the position on Friday with my trailing stop rules, because the previous day we closed above 70 RSI, and then on Friday we closed under the 70 RSI. So that got me out of half of the trade. Now, I know I have a lot of rules here, and this particular podcast, I try to, at a high level, explain what I'm doing. But if you are interested in learning exactly how I trade, learning, internalizing all of these rules that I have, because in my opinion, taking the trade is very easy, but how you manage it is the most important thing. I think that's the difference between profitable traders and unprofitable traders. So I do provide a one-on-one course. I've taught people from all over the world, and I do the one-on-one course in the evening time via Skype. The The lessons there, it's a total of 15 hours, 5 sessions. Each session is 3 hours, and I teach you all of the different trading approaches that I use, the trailing stops, the emergency stops, all the trailing stop rules, how to position size. And if you really want to take trading seriously, I would love to work with you. And my email is in the link of this description. Just send me an email. I'll reply, and we'll try to set it up. It costs $1,750, but it's worth every penny, I promise you. And like I said, I have taught students from all over the world. I know they're very happy that they took the course, and I think you will be as well. So again, rejection of the 200 and the 250 and the 300 SMA. That's why I entered 342.70, moved up, started taking partial profits. Here we go, all the way Thursday we closed above 70 and then closed below 70. I took half off for a profit of 8.77 or 27? 8.77%. Now, if I have a close below this 5 EMA at this point, because we got up to 65 RSI, if I have a close below the 5 EMA, I will take the entire profit, or take the entire position off. But great trade, great illustration of sideways motion, holding support, and then leading to a trend. From here, we may continue sideways, have another leg up, that's potential, or we could start moving sideways here and have a leg down as well. Right? But glad that I locked in 8.77% here. And again, going forward, if I have a close below the 5 EMA, I will get out of the majority, or I will get out of the rest of the trade. So that's MasterCard. Apple. All right, I did take Apple all the way back here on the 29th of December. What was the entry signal? The entry signal was a close under 30 and then a close back over 30 RSI. So I position size, take my maximum allowed loss divided by the 2 ATR. That shows me how many shares to buy. I place my emergency stop 2 ATRs below. So at this point, it's either going to go down and close below the 30 RSI, in which case I would get out. Almost got me here, but it did close above the 30, so I kept it, right? And then moved sideways for a few more days, and then we've had a nice move up. Had a nice move up here, took some profits off here, took some profits off here, took some profits off here. Here on Thursday, based upon my rules, I did take half of the position off, because when I take an under 30 over 30, then its next kind of natural level of resistance above will be the 50 RSI. There's this kind of interplay between the 30 RSI and the 50 RSI. And if you can get above the 50 RSI, then the interplay is to the 70 RSI. But I always want to be defensive, and by it going above 50 RSI intraday and closing below 50 RSI, that was my signal to take off half. It went up on Friday, right? Am I bummed that I sold half on Thursday? Absolutely not, right? My process told me to do that. I locked it in. Who knows? It could go screaming down next week, and I'll be really glad that I took half here, right? And that's one of the great things about taking half. It's one of the win-win situations in trading, because here I took half. Okay, locked in 2.85%. If it goes up, I'm still happy because I have half. If it goes down, I'm happy that I sold half, right? Not a lot of win-wins in trading, but for me, taking half position is really a win-win, because like I said, if it does keep going up, I'm glad I still have some. If it goes down, I'm glad I sold some. So here we go. The half position, I locked in 285. My next level that I will be looking for will be a rejection of the 50 SMA. If that happens, then I will get out of the entire trade. Alternatively, if I get to the orange line, then I'll get into trailing stop mode. Trailing stop mode is when you have an entry and you move 1.5 ATRs above your entry. And if you do that, then if I get a close below a previous bar's low, then I will be out. So an under 30 over 30, if 2 of 3 things happen, I'm out of the trade. So again, under 30 over 30, if it rejects the 50 RSI, I'm out of half. If I get to trailing stop level and then I have a close below a previous bar's low, then I'm out of the other half. Or alternatively, if I reject the 50 SMA, then I will get out of half. And if two of those three things happen, I'm completely out of the trade. So one did happen here with the over 50, under 50. So I'm out of half. If I get to trailing stop level and then have a close below the previous bar's low, I'm out of the other half. Or alternatively, if I reject the 50 SMA, I will also be out of half. But this trade on the half that I took 2.85%, and the remaining percent is up 3.91%. So nice trade on Apple. ARC. Well, this has been quite a trade. One of my favorite setups that I talk about on this podcast and that I talk about in my one-on-one course is a higher low V1. Now, a higher low V1, the requirements are we have to close below the -1 ATR channel. This is the green line. That's the -1. The top green line is the positive Keltner channel or ATR channel. And the requirement is we have to close below the -1 ATR channel. Then we have to bump our way up into the value zone. And then we have to have a pullback with the V1 or a V2 entry. And you hear me talk a lot about V1, V2s. They're really one of my bread and butter in trading. And higher low V1 is one of my favorite setups, because if you're below, if you have a low and you're below the -1 ATR channel, and then it moves up, well, you've run out of sellers here, and that's why you moved up. But people that were lucky enough to buy down here, if it moves up, they're probably going to sell. That's what causes this second move down, right? But then if you have a new group, it's basically a whole new group of buyers that come in on a V1 or a V2. Now everyone that wanted to sell has sold. These people have all gotten rid of their shares, and that's why it rallied. People that bought here, they're selling, it moves back down. And that's why higher low V1 or V2s in the value zone can lead to a nice, easy up move, because you have run out of all the sellers. All the people that wanted to sell here sold. All the people that wanted to sell here sold. And so that makes for an easier up leg because there's no more sellers left. There's no more, you're not running into people wanting to sell. And that's what causes these nice legs up. Lower lows tend to, like here, lower lows tend to go up and then fail. Higher lows tend to trend. So it's a very important concept. So here was the higher low V1. Here is bar 1, here is bar 2. Bar 2 washes out or goes below bar 1's low, closes above bar 1's close. Of course, I position size. I take my maximum allowed loss. I divide it by the value of the 2 ATR on that particular bar. I place my emergency stop exactly that far below, but then I have my end-of-day stop. And my end-of-day stop on a V1 or V2 is just a close below halfway of this washout bar on the V1 or the V2 trigger. So look, my risk was very small here. I entered at 31.27. If it closed below 30.76, I would be out, ideally for a small loss. But look, it really just rocketed up here. Of course, as it moves up, I take partial profits here, take partial profits here, take partial profits here. Did not hit a partial profit here. But I am above the 1.5 ATR trailing stop level. So now if I have a close below a previous bar's low, I am just out of the trade. We're at a 61.91 RSI. If it gets to a 65 RSI, then my trailing stop level of the 5 EMA comes in. And so again, if it gets to 65 and then closes below the 5 EMA, I am completely out of this trade. But this trade has been a monster. It's a perfect illustration of why higher lows work so well. This particular trade from entry to current price up 13.14% in the last week. Incredible. Very, very grateful for that. Tesla. All right. Well, same thing on Tesla. I did take a higher low V1, very similar to what ARC looked like. We closed below the value zone. We poked our head into the value zone. We came back, created a V1. Here's bar 1. Bar 2 washes out the low of bar 1 and then closed above bar 1's close. Now, there was some bad news on Friday, and it opened up down. Didn't look good. Here's halfway of the washout bar. That's my stop. If it closed below my stop, then I'm out of the trade. Well, it opened below, but you see how it closed back above that halfway. Now I am slightly down on this trade, but it's a good illustration of why I like to wait till the end of day to make my decisions, because like I said, the large financial institutions come in end of day. I believe they're the smartest money, and it gives you a good idea of where the market is going based upon that closing price. Now here's my emergency stop down here. Obviously if it would have just kept going down and got to here, I would have just had to get out, give up, but I know exactly how much I'm going to lose. So that's the important part. So this particular trade down very slightly, let's see, from here to here, about 0.81%, but it did close halfway of the washout bar, so I am still long on Tesla. SPY. I don't do a lot of shorting, but I had a lot of long positions, and this was a great setup. On Thursday, we rejected the 200 SMA. I got short at 396.90. Obviously, if you're short, you want the trade to go down. I placed my emergency stop 2 ATRs above. Everything's opposite when you're shorting. And then my end of day stop was a close above the 200. Well, that happened. It did happen on Friday. I mean, it gapped way down. I was like, wow, that was the best trade ever. And I did take some profits when it was down, because I always take partial profits if it moves my way the value of 2 ATR. Well, this was a 2 ATR move, or I'm sorry, 2.45 ATRs moves. So at the open, I took off 20% of the trade, right, at profitable levels. It did close above the 200, so I did get out and took a loss on the 80% that I had left of 0.4%, not too bad, but all in all, it wasn't a 0.4% loss. It was less than that because I did take some at profitable levels, but it did close back above my end of day stop. I had to get out. So on the remaining shares, I had a total loss of 0.4%. So those are the daily trades that I have. MA still in there, took half for 0.877% gain. Apple took half on Thursday for 3.9% gain, and the current position up 2.85%. ARC have not taken any trailing stop levels or sold half, up 13.41. Tesla slightly down 0.81%, and SPY got out for a 0.4% loss. Now let's go to the weekly trades. Now I tell you, this was a little bit of a frustrating trade for me, but again, it shows the advantages of taking partial profits. I bought Joe, which is weekly on the weekly charts of coffee, when I had a confluence of signals here. It bounced at the 200, also an under 30, over 30. Of course, as always, I placed my emergency stop. Where's my end of day stop, or in this case, end of week stop? Well, it's simply going to be a close below the 200 because that's why I bought it. But the next week it went up. I took some profits. I took partial profits. A few weeks later, I took 2 partial profits. So I took 30% of this trade off at profitable levels. It never quite got to my trailing stop level. And then on Friday, boom, 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 all the way down. And I had to get out of the trade for a 2.01% loss. However, when I go through what I'm looking for next week, if we have a close back above that 200, I will definitely get back in. But this is a small loss, and it was mitigated by taking the partial profits, and that is the advantage of taking partial profits. If it turns back around on you, it helps mitigate the loss. So this one was a bummer because this one was up about 10%, but it never got to my trailing stop level. And on Friday, I had to honor my rules with a close below the 200. And now I'm below the 200. But if it closes back above, I will definitely consider getting in. But this particular trade, this weekly trade, ended up with a negative 2.01% loss. Google. All right, Google. Why did I buy Google? I bought Google looking for a support level that was rejected. The support level was the 250-week moving average, right? Got long 88.90, placed my emergency stop 2 ATRs below. My end of week stop would simply have been a close below the 250. The next week it went below the 250 but closed above, kept me in. Next week, again, tested below, closed above. That kept me in. That level was valid. There were no more sellers under that. And you can see even back here, we rejected the 250. So that the price of Google, GOOGL, is respecting the 250. And that is important. And this also was a higher low rejection of the 250. This is a lower low. Clearly, we're below these lows. Not as good, still valid, but it did exactly what lower lows do. It bounced and then came back. This one here, you see how this rejection, the 250 rejected, but this low is higher than this low. Well, higher lows are always better the trade to take. They really, really are the better trade to always take. If you're looking at two stocks and you're trying to decide which one do I want to, oh, this one rejected the 200, this one rejected the 200. I would always take the one that's a higher low situation. So I hope you can see that this rejected the 250, but it came at a higher low. This low is higher than this low and had a great week. Obviously, it's moving up here. Here's my trailing stop level. Have not got to that yet, but this particular trade is up currently 3.51%. Now, we do have earnings coming up on the 2nd of February. I never hold through earnings. So the night before earnings, or the day of earnings, because Google reports after the close, I will get out of the trade. I never like to hold through earnings. Man, excuse me. And regardless of where we are, whether it's a loss or whether it's a gain, I will get out the night before earnings of the next day. But this particular trade up 3.51% on the weekly. SSO. Great risk to reward ratio. I bought this last Friday, so I've been in it 1 week. Why did I buy it? Just a very simple close under the 200, close over the 200 on the weekly. Weekly bars expire on Friday, so I took this last Friday at 45.60. Again, it came from a higher low. Look, here we had a close. Here we had a rejection of the 300. This came from a lower low. This is a higher low to these lows and these lows. So that's why I took the trade. I took it at 45.60 with a close over the 200. If it's over the 200, I want to be long. It gave me a very good risk to reward ratio. Of course, I have my emergency stop down here. This week, if it would have closed below the 200, I simply would have gotten out, right? But it didn't. It rallied nicely. Here's my 1.5 trailing ATR stop. I did hit 2 profit targets on this, so I took off 20% of the original position because it moved my way in this particular trade from entry to current price, up about 5.24%. IWM. Been in IWM for a long time, actually. Bought this all the way back on the 14th of October because of the rejection of the 300 SMA. That's a legitimate level, gives me a very good risk to reward ratio. Of course, I have my emergency stop all the way down here. So if if it went down there, I would have immediately gotten out, known exactly how much I would have lost. But this trade's been great. Bought this at 167.19, placed my trailing stop up here, took partial profits on the way up. 2 weeks later, we got to trailing stop. Doesn't mean I do anything. It just means in the future now, if I have a close below a previous bar's low, I will get out of half. And we went up. We did not have about 6 weeks ago or so, had our first close below previous bar's low. I got out of half at 178.70, locked that in, came back down, looked a little scary, but huge move back up. So this is one of those situations where here, when I had the trailing stop signal to get out, and then it went down, I was like, ooh, boy, am I glad I got rid of half, right? Because I locked it in at 178.70, and then we got all the way down. It's like 170, but nice big move back up with the other half. Very grateful for that. And the half position that I have is currently up 10.64%. So really nice. Microsoft. All right, here we go. Been in this for a while as well. I bought this back on 11/4/22 with a rejection of the 200-week moving average, got in at 221.34, placed my emergency stop. My end of week stop would simply been a close below the 200, moved up to partial profits, got to trailing stop level, continue here, took some more profits. Here, took 2 profits, definitely above 1.5 ATR trailing stop level. And then a few weeks ago, I had the first close below the previous bar's low, got out at 239.50 for half. Last week, it came back down, and see how it tested the 200 again? I could have gotten, here I took profits off with the trailing stop level. It would have been okay for me to just completely get into a full new position with this new bounce at the 200, because you can see this 200 is respecting this, but I didn't, but just wanted to point out that you could, and then had a nice big move up here. The second half of Microsoft that I have is currently up 7.47%. We have earnings coming up on the 24th, so again, I will get out before. So really great trades on the weekly. Joe, just recap, loss of 2.01%. Google, profit of 3.51%. SSO, profit of 5.24%. IWM, profit of 10.64%. And Microsoft, profit of 7.47%. And so I hope this is helpful, that it shows you, why I take the trades, how I manage these trades. Again, if you are interested in working one-on-one with me and doing a one-on-one study course, I will show you everything I know that I've been using, and all the approaches that I use and all the rules that I use in my one-on-one mentoring classes in the evening time. So if there's interest in that, just send me an email, Gregory at Gossett Trading. It's in the description below. Okay. All right, let's get started with a little trader psychology. Always the most important skill in trading is the ability to create a plan and follow that plan. Sounds easy, right? No, it's not. If you've been trading for a while or any period of time, you probably know that is not the case, because looking at the profit and loss on a trade can amplify your emotions, it can get you off of your process. Look, let me just tell you something from the bottom of my heart. You will do better in trading. You will make more money if you follow your dang process. And it's harder than it sounds, but that's the skill, everyone. The skill is not really in reading the charts. I mean, you have to do that, of course, but the real skill and discipline of trading is the ability to follow your plans regardless. There's so many times we're going to think, oh, it seems high enough, I'll just take it, right? Well, follow your plan. If your plan tells you not to take something, then don't take it. You have to sit on your hands. I mean, let me just go back real quick to ARC. Look, at any time, I could have thought that's high enough. When I bought it the first day, I could have gone, that's it. The market's been going down after every rally. Well, trust me, I wanted to. I wanted to take the trade, but look, my process didn't tell me to. And thank God I didn't do it, right? I mean, this is up 13.14%. Now, if it closes below the previous bar's low, yes, of course, I'm out of there. If it gets to a 65 RSI and then closes below the 5 EMA, I'm out of there. If it rejects the 70 RSI, then I sell half. And then if I have a close below the previous bar's low after rejecting the 70, then I'll be out of the entire trade. But the point I'm trying to make is this went up at any time. I think I justifiably could have said, I'm out of here. I'm out of here. It's too high. The market's been going down. It's going to go back down. Well, I just stuck with the process, and luckily my patience paid off in this trade. So let's go back here and take a look here. This is from Money Trade Edge. Money Trade Edge. Better thinking, better trading. Great channel on Twitter. Follow it. I promise you, the posts are very succinct, but they carry a lot of weight. Show me a disciplined trader, and I will show you a successful trader. Short and sweet, right? Show me a disciplined trader, and I will show you a successful trader. You have to be disciplined. I know it's fun to go out there and gunsling and boom, I'm in, boom, I'm out. But that's more entertainment, everyone. That's more entertainment. If you want to take this professionally, do this as a profession, you have to follow your rules. Show me a disciplined trader and I will show you a successful trader. Do you want to be successful? Do you? Well, then you have to be disciplined. There's no two ways around it, everyone. And so when I read this, it really spoke to me because I battle with this as well. That's why I spend so much time with my rules, and I just have to be steadfast to my rules. Because if I don't have rules in trading, if you don't have rules in trading, you don't have anything, right? So short and sweet, but show me a disciplined trader and I will show you a successful trader. Sit down in a quiet room, think about it. Are you following your rules? If you're not, you've got some work to do and you have to follow the rules. Unless you just want to have fun and gamble like in Vegas. But if you want to do this professionally like a casino, casinos have all sorts of rules they follow. Always. Every single part of every transaction, of every roll of the dice, of any spin of the rules, it's all rule based. So if you want to be professional, get your rules and follow them by being disciplined. Okay, before we get over to what I'm looking at next week, let's do a quick poem from my good friend Frank, the trading poet. Great poet, great trader, great musician, great journalist, and follow him. You'll be happy that you did. At Franco D over on Twitter. Let's see what Frank has to say today. What poem he wrote. Every gain should come with a cautionary tale. Don't leave those profits sitting on a table. A trailing stop locks in that money and keeps your trade stable. The market rewards those that are prepared, willing, and able. And of course, this all dovetails back into what I just mentioned about having a process, having rules, following your rules, especially the trailing stop. I have all sorts of trailing stop rules in my trading, and you need them. You need them because you need to navigate. You need a roadmap or if-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. That's the great thing about what I teach in my one-on-one is I teach you these rules. You never have to make a gut decision. It's basically mechanical based upon what the market is doing and what the price of the stock or whatever market you're trading is doing. That's the truth, not what you read in the newspaper or online or what talking heads tell you on CNBC. I mean, I remember, what was it, Kramer just a couple weeks ago was like, yep, well, you're just going to have to take this loss. And then we have this massive rally, right? Do what the market is telling you, what price action is telling you, not what people that you know are telling you. So one more time, every gain should come with a cautionary label. Don't leave those profits sitting on a table. A trailing stop locks in that money and keeps your trade stable. That's so true. A trailing stop locks in that money and keeps your trade stable, or in other words, keeps you stable. The market rewards those that are prepared, willing, and able. Such a great poem. So relevant, so true. Thank you so much, Frank. Appreciate that. And please follow Frank over at FrancoD over on Twitter. All right. So, as I discussed, we're going to go through some potential daily setups for next week that I'm looking at, and I'm going to go through some weekly trades that I'm sitting at. There's not a lot of trades this week. I mean, I have some potentials for sure, but we've rallied here. I was a lot more excited when we were lower because we had those 300s, 250s, 200s that we were looking at potentially base our trades off of. Well, we've had quite a big move up here, and so not a lot of as many different trades setups. We're probably going to have to wait for a bit of a pullback for me to get interested in a lot. But some trades, you're looking for continued movement up, and this is a good example on Apple. Now, I'm already in Apple, but there is a very good back-tested approach on Apple that I am looking for next week. Now, I'm already in the trade, so I'm not going to take it, but this is just a good teaching moment. Here's the 5 EMA. Here's the 20 EMA. These are called crossovers. If you have a 5 EMA crossing over the 20 EMA and you backtest that over time with Apple, you will see that there is an edge to that trade. But the 5 EMA right now is 132.64. The 20 EMA is 132.78. So the 5 EMA, 132.64, is not quite above the 20. But if it does have a crossover, doesn't mean that trade has to be positive, but over time, that particular setup, that particular signal has generated more money than it has lost. So we have not had a 520 crossover on Apple for a long, long time, but we are getting there. So next week, if we have a 520 crossover, that is a legitimate signal. And if it happens, I've scaled out, right? I took half at 2.85%. I have a current positive 3.91% on this trade. But if the 5 does cross over the 20, then I may morph the trade into a new trade based upon the 520 crossover. Does that make sense? So if the 5 does cross over the 20 next week, I may consider just morphing it into a brand new trade with a full new position size. But 520 crossover on Apple over many, many years, decades, has been a good signal. And that's what I'm looking for on Apple. Anheuser-Busch. Well. Anheuser-Busch, I'm looking for a short position. And let me explain why. And again, this is what I teach in my one-on-one trading course. There's something called the double top with a bearish divergence. I learned this from studying one-on-one with Dr. Alexander Elder, and this is what's happening on Anheuser-Busch. And let me explain something about Anheuser-Busch. Anheuser-Busch has had a massive rally. Look at this. This stock back in October was $44. Now we're $60. Look at this move. It is incredible. But if I look at Budweiser in a fundamental way, yes, they pay a dividend. It's less than 1%. So that's not very appealing. Is there a huge growth story in Budweiser? I mean, are a lot more people going to start taking up drinking? I don't think so, right? So looking at this stock here with this huge move, I'm like, why are people buying this? Well, they are. I don't want to fight it. But from a fundamental standpoint, I don't see the growth. I don't see the allure of this company at these prices. But I'm not going to just go ahead and short something based upon that. But let me show you what's going on here. See this big move up here? You see how tall these MACD bars are? This is showing a lot of momentum. Then we got higher. We pulled back into some red. And now we've gone higher. But if this were a healthy stock, then this move higher would have been confirmed with green bars. But there are no green bars. We are continuing to go higher and higher and higher. And the MACD momentum is showing lower, 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 lower. We are running out of buyers up here. That's what MACD is telling you. And the implication of that is that we're going to be heading down. So again, we have the move up here with tall, strong MACD bars. That shows healthy strength. We pull back to red bars, which is normal. But now we have gone higher with no MACD bars. We are running out of buyers. Another divergence situation. Here we are at these highs. Look at the RSI. RSI is very strong. A few days ago, when we broke out to a new high, see how low the MACD bars are? The RSI is. If this was healthy, this high here would have been confirmed with at least as high RSI over here, but it's not. This is a bearish RSI divergence. The MACD is a bearish MACD divergence, and there's also something called an ATR divergence. Well, look, at these highs and these highs, we are at the 6th ATR channel, okay? A few days ago, when we made the new high, we were only at just a little bit above the 2nd ATR channel. Over the 6th ATR channel here, now we're higher, we're at only the 2nd ATR channel. This is a MACD divergence, it's an RSI divergence, and it is an ATR divergence. And then you overlay that onto why is this company going up? Where's the growth? Where's the dividend? Not there. So this is a good example of fundamental and technical analysis. Yes, I definitely want to get short Budweiser. The key is, where am I going to do it? Well, here was the previous high. We broke out of that high, and now we came back down. So this was a false breakout from a previous high. That by itself is not a good sign. But then we did rally on Friday. What I'm looking for is a rejection of this previous high. So in this coming week, if we do get above this previous high here, 61.64, and then pull back, that will be my short signal. Where will be my end of day stop? Well, if it closes back above that high, then I'll just get out, hopefully for a small loss. And then I'll place my emergency stop up here as usual. So again, just to be clear, what I'm looking for on Budweiser, and this is a very high conviction trade for me. I don't know if it's going to get up here and reject that. I could see it happening. But if it does get up here and reject 61.64 and head back down, then I will definitely get short Budweiser. If it closes back above, I'll get out for a small loss. If it heads back down, I'll take my partial profits on the way down. If it gets to my 1.5 trailing stop level, then if it closes above the previous bar's high, I'll get out of half. Just the same way that I do it with the long side, but this is the short side. But I am I have a very high conviction on Budweiser to get short because of the ATR divergences, because of the MACD divergence, because of the RSI divergences, and also the fundamental standpoint of where is the growth in this company. There's no compelling dividend story here. There was when it was way down. Of course, you get a higher dividend when it's lower. But now that it's up here with all these divergences, and I don't know where the growth's coming from. I don't think there's an appeal for the dividend. And also, the reason that we moved up on this stock was because it was a flight to safety. Whether it's toilet paper companies, beer companies, things that people are going to buy pretty much regardless. That was a safety play. And I mentioned that last week that I've seen a lot of these consumer defensive stocks kind of start to sell off and have these divergences. Well, that's showing me that people are moving their money out of these defensive stocks back into some growth stocks like Apple, like Google, right? Like ARK. And that's exactly what happened. So I do think in the future, when you look at Anheuser-Busch, in a month or two, it's going to be much, much lower than it is. But again, that's my opinion, right? That's my filter based upon my analysis, but I still have to wait for some legitimate signal for me to get short. And again, next week, if we reject 61.64, which was this previous high, then it will tell me that the market tried this high, still rejected it, and that's probably when we will have our move down. I talk about higher low V1s, V2s, higher low 200 to 300s. Well, it's the same for lower highs. And if we had a V2 to the downside, I would consider also getting short here. Here's bar 1. Bar 2 goes above bar 1's high. If on Monday only we close below Thursday's close, then I'd have a lower high V2. And those are the ones that start to trend down. So if it closes below 60.49 on Tuesday, because Monday's a holiday, then I will get short. Alternatively, if we reject the high of 61.64, I will also use that as my line in the sand and get short there. And by the way, I talk a lot about V1s, V2s. Of course, I teach these in my one-on-one courses, but I do have a free video on YouTube. If you just go to the Gossett Trading and Mentoring YouTube channel, go to the playlist section. There is a link there for a video on V1s, V2s. And again, they're really a bread and butter of my trading, and they're great. It's free video. Go and check it out. I think you'll really, really enjoy it. And I believe it's in the link of this description of this video as well. So very high conviction, probably more conviction on this Budweiser trade than any other thing I've seen, but to the short side, but I still have to wait for a signal. J&J. Well, again, this is kind of a good example of these consumer defensive stocks starting to sell off and money rotating into growth because we were much higher here. Again, look, here's a high, tall MACD bars, pull back to red, make another high, no green MACD bars whatsoever, even though we're testing new highs and new highs and new highs. And then look what happened. It sold off. That's exactly what I'm expecting Budweiser to do. Now, we are down to some support levels here. We are down to the 200, not quite to the 200, but buyers, large institutional buyers, savvy investors, they are going to wait for some kind of rejection of the 200. And if I get a rejection, either a close under, close over, I'll get long. If I get an intraday rejection of the 200, I will get long. Doesn't mean it has to go up, but it gives me a good landmark. It gives me a good line in the sand to construct my trade from. Let's look over at the weekly. Are we coming into any support over on the weekly? I like to always look at multiple time frames to look for multiple levels of support. Well, we are back in the value zone. It did reject the 20 EMA. I'd like to see it reject the 50. And if it rejects the 50 EMA on the weekly, it will also have rejected the 200 on the daily. So it's important that you look at multiple time frames. Do I have support on the time frame that I'm looking to enter? Yes, okay, I do. But do I also have some kind of support on the higher time frame? You usually want to use a factor of 4 or 5. So if you're trading like a 5-minute bar intraday, you want to look at the 25 or the 20-minute bars to look at that for that confluence. Of course, if you're trading daily, looking for a rejection of the 200, I also want to look for some kind of rejection on the weekly, the higher time frame. So that's what I'm looking for on J&J, looking for a rejection of the 200 to get long. Coca-Cola. Again, consumer defensive stocks, you can see money flowing out of these defensive stocks. Just want to point out again, here's a high, MACD bars, strong, pull back to red, go back, another high, no green. That's a double bottom or double top with a bearish divergence. And that's why I'm so excited about Budweiser, because I believe it's going to do the same thing. And you can see that double top, bearish divergence, also RSI divergence. Look at the high here. Strong RSI reading. High here, we got higher, less. Didn't happen immediately, but look where we are now. Now, this would have been a legitimate signal on Friday. Why? Close under, close over the 200. That's totally legitimate. Didn't take that because I have quite a few positions already. But next week, really, my gut tells me here that a rejection of the 250 would be a good entry signal, or a rejection of the 300 would be a good entry signal, or if we close under, close back over the 200, that would also be legitimate, like it did. So this was legitimate entry on Friday, but I didn't take it. I really would like to have something lower here at the 250 or the 300. Let's look at the weekly, see if we have some support. Well, I think we do. See how we rejected the 50 SMA on the weekly? So multiple confluence of signals, rejection of the 50 SMA on the weekly and a rejection of the 200. That's why it would have been valid on Friday, but I didn't take it. But again, really just from experience, I think the 250 or the 300 is really what I would be looking for on Coca-Cola next week. Lockheed Martin. Well, I guess today is bullish divergence day. Let me show you again. Look at the highs here. Tall MACD bars. We pull back to red. We make a higher high. Is it confirmed by higher MACD bars? No, it is not. No green whatsoever. Again, that's showing that we are running out of buyers. Look, up here, we're near the 5th ATR channel. Here, we were only at the 2nd ATR channel. Look at the RSI. RSI high here, higher over here, but lower. Same thing with Budweiser. Has the triple bearish tops, bearish divergences. And look, but now what do we do now, right? If we miss that trade, what do we do now? Well, look, that 200 is coming into view, isn't it? This was actually a legitimate entry on Friday because we went under 30 over 30. But what I am really looking for confluence, I'm looking for a rejection next week of the 200-week moving average. That would give me a good risk to reward ratio at a very solid, substantial support level of the 200. Let's look over on the weekly, see if we can find any support levels on the weekly. None to speak of really, but we are back in the value zone. See, you move above the value zone, and you're always going to come back to the value zone. I want to buy in value, sell above value. I want to buy below value, sell in value. So just the fact that the weekly is in the value zone, I like that. And then overlay the daily on that, look for the signal. Well, the signal was legitimate on Friday, under 30, over 30, and an under the negative third, over the negative third Keltner channel. 92% of prices tend to bounce when we get down to the negative third ATR channel, and we are there. So again, this was completely legitimate, under 30, over 30, in rejection of the negative third ATR channel. I didn't take it. What I'm really looking for is a pullback to the 200. That would be a great risk to reward ratio. Doesn't mean it's going to have to be positive trade, but it's waiting for what I want. Great levels with great risk to reward ratios. That's the key to profitable trading, and that is what I teach in my one-on-one courses. Merck. Merck is an interesting for a short. And again, double tops, bearish divergences all over here. Merck has been a great performer. It's outperformed the market substantially. But in this market environment, with all the growth stocks really going down, people were looking for safety in consumer defensive stocks. They were looking for safety in pharmaceutical stocks. And look, we have the dreaded double top bearish divergence. Here's the high, strong MACD bars. We pull back to red. Now we've gone higher, higher, higher. No green MACD bars whatsoever. RSI, high over here. We're higher here, lower. Here, we're near the fourth ATR channel. Here, we're higher. We're only at the third. So that's telling me that we are running out of buyers again. And the implication, it's going down. Now, if you follow ICT on YouTube, he teaches fair value gaps. And this is a good example of marrying what he teaches with what I teach. He would say, okay, here we have a level of liquidity. We broke above the level of liquidity. Now we've broken down, went under the previous low. We have a market structure change. Wait for a check back into the value, or into the fair value gap. Here is the high of the fair value gap. Here's the low of the fair value gap. This right here, right now, would be legitimate. And your risk to reward ratio, your end of day stop, would be a close above this high. Well, I am going to wait for the market to potentially test the top of this fair value gap, because it gives me a better risk to reward ratio. So this is a legitimate IC trade. Look up ICT on YouTube. I think you really enjoyed it. A lot of my students are following this as well. I do as well. But in taking his setup and his approach to trading, with a running liquidity, breaking market structure, checking back into the fair value gap, that's great. But overlaying that with what I do with double tops, bearish divergences, MACD divergences, RSI divergences, ATR divergences, this is confirming both of our approaches. His approach with fair value gaps, my approach with the lack of momentum. So just to be clear, next week, if Merck touches 114.05, I will immediately get short on this trade. My stop will just simply be a close above the high here. But again, with consumer defensive stocks, pharmaceutical stocks, I think the money is at this point coming out of these stocks, going back into growth. Shopify, well, really big, strong move over the 200. Now, could I have taken that on Friday? Yes, I could have, but the risk to reward ratio is not great, right? If my end of day stop is a close below the 200, I want to get it as close as I possibly can. This is a little chasey. I use the word chasey. It's a little extended. I think it's very likely that we will come back and test this 200. And in addition to that, do you see how the 200 dovetails right at halfway of this bar from the low to the high, right about halfway? There's going to be some inherent support there at the halfway from a Fibonacci standpoint, but I like how the 200 is right there at the halfway. That's a double confluence for me. So this may just continue up, in which case I'll just wish it well. But if it does come back and retest the 200, for one, it's retesting the 200, and for two, it's coming back to halfway, which should have some inherent support. So what I'm looking for next week on Shopify is another retest of this 200 to give me a better risk to reward ratio. At the same time, that's going to happen at halfway of that bar. So if and only if it comes down, tests this 200, gives me a good risk to reward ratio, and closes back above the 200, I will get long Shopify. But this has been a big move here. I would not be surprised by a little bit of a pullback to retest that 200 and the 50% Fibonacci number here on Shopify. SPY. Well, this was the trade that I had. I took the short, didn't work out because it closed back above. But if we close back below the 200, because of this huge move up here, I would consider getting short SPY if it has a nice gentle close below the 200, give me a good risk to reward ratio. And, you know, I have a lot of long positions here, so that's why I am looking for some short positions to kind of hedge a little bit. Not a bad idea to do, but a close back under the 200 would be a very legitimate reason for me to get short again, just like I got short on Thursday. Tesla. Why do I have Tesla on here? Oh, disregard. This was just from the trade that I have, the higher low V1 that I trade. Not sure why I have this on here. My apologies. UUP. Okay, UUP is the dollar. Now, in this particular market, as the dollar goes down, that's generally been good for stocks. Now look, we are at a 33.92 RSI. We've had a huge pullback in the dollar. I would be expecting some kind of bounce. And so, I mean, you just look at this and you realize, yes, there's probably a bounce coming. A bounce coming in the dollar would probably be bad for stocks. So that's something I'm looking at. Right now, we're at the negative third ATR channel. If we have a close back above the 300, I would simply get long the dollar. And then that would affect my approach to stocks too, because if we have a rally in the dollar, we're probably going to have a pullback in stocks. So, you know, you want to look at things like the VIX, you want to look at things like the dollar, you want to look at things like bonds that give you an idea of where the tailwinds are or the headwinds are for stocks. And so, you know, with this big move down on UUP on the dollar, yes, that's good for stocks, but we are at the negative third ATR channel. We're in the low 30 RSIs. I would expect some kind of bounce in the dollar and some kind of pullback in stocks. But as far as a entry trade to capitalize on that and execute, simply a close under the 30, over the 30 would get me long UUP, and a close back over the 300 would also get me long UUP. So those are what I'm looking for on the dailies. On the weeklies, let's head and do weeklies. Only a couple on the weeklies. I've been talking about a short on AGQ, which is silver, for quite a long time. It's never gotten to my entry point. That is why I have not got short here, but I'm looking at the 200 week moving average. And do you see how the 200 week moving average also dovetails with the third ATR channel? That's a confluence, a lot of resistance there. 200 is going to be a substantial amount of resistance. The third ATR channel is going to be a substantial amount of resistance. So if and only if next week by Friday we have gone above the 200 and then closed back below the 200, that will get me short AGQ. Now, I like to talk about multiple time frames. So the higher time frame to the weekly would be the monthly, and you can see the 100 week month moving average is at the same level as the 200 week moving the 100 week monthly average right here is the same level as the 200-week moving average. Doesn't mean it can't go higher than that. It just means that the price is dealing with a lot of resistance on multiple time frames. On the weekly, the 200-week moving average, the third ATR channel, for the 100-week moving in average in there, where there's a lot of confluence of resistance right here on the weekly. And then when you look at the monthly, same with the 50 EMA, the 100 EMA. So doesn't mean it can't go higher than that, but it does look to me on multiple time frames, there's a lot of resistance there. And so just to be clear, next week, if we go above the 200-week moving average, close below the 200-week moving average, then I am out of there. I'm sorry, I am in there on a short position. If the the following week, it closes above the 200, then I would get out. But I think that is a very good risk to reward ratio using multiple resistance levels on multiple time frames. And I've been talking about this for a month, but we have not got there yet. But if it does, I am definitely shorting. JO. Okay, JO. I had this trade, and it turned out to be a small loss, but this 200 and this 250 here week moving average, if we get it closed back above the 200 next week, I'll get long again and try it again. You know, from a human perspective, if you take it under 200, over 200, and it fails, it's no fun. You had the losing trade. But from a human perspective, if it closes back above, the right thing to do is get back in. But it's kind of like you don't want to because it didn't work the last time. I've had so many trades in my career where I've taken a close under, close over 200 and it failed. I tried it again. It failed. The next time I was like, ugh, it's not going to hold again. It didn't hold the last two times. But then I do, and then it has a rip-roaring trade. So just a piece of advice, if you have a valid trading signal and you've had one loss, two losses in a row, don't be afraid to take that next entry signal because a lot of times that's going to be the one. But they have to be legitimate signals. So circling back to JO, if we close above the 200-week moving average, I will get back in the trade. And that's all I have on the weeklies. So at the beginning of the podcast, I talked about my one-on-one course. Look, it's a great course. It's 15 hours of instruction. If you want to learn anything, whether it's ice skating or tennis or basket weaving or trading, the best way to do it is to do it one-on-one with an experienced teacher or mentor like myself. It's just always better to do it one-on-one and do a long form course. And that's what I provide in the evening time via Skype, 5 sessions. Each session is 3 hours long. I teach you step by step all the different approaches, all the different rules. It's very important to me that my students succeed. Just because, one, I want people to succeed. That's why I started this. That's why I started teaching. And, you know, it's good for my brand and the whole thing. But if you're serious about trading, if you really want to learn proper trading fundamentals, if you want to learn 5 different trading approaches that use proper trading fundamentals and setups, and a very patient teacher like myself, just contact me. My email is in the link. Just send me an email. I will reply and say, hey, thanks for reaching out. Appreciate it. Let's do a Skype call. It's a free Skype call. It's not a sales call, I promise you. I just want to learn more about you, your trading, your objectives, your challenges, and it's a great time for you to ask me any questions about the course. And when we're done with the call, I will never contact you again. It's completely up to you to reach back out to me if you decided, you're considering, should I take this? If you decide one day, yeah, I want to do it, just send me an email. Greg, I'm ready to take the course, and we will do it. Like I said, the course costs $1,750, but it is worth every penny for what you get. All the time, all the attention, all the questions, the answers, and I'm a pretty dang good teacher. So if you're interested, my email is in the description. If you like online courses, I have a great online course available at udemy.com where I teach you step by step the deep dip buy trading strategy. And most of the trades that I showed you this week, not all of them, but the majority of them were deep dip buy trading strategies. I teach you step by step. It's very affordable. It's only $12 or $15. You can get it on udemy.com, but don't let the low price fool you. There is so much content there, 9.5 hours of video just on the deep dip buy, 15 study guides, 26 videos total. I've sold so many of those around the world, gotten so many good reviews, so much good feedback. And, if you're starting to trade, you want a good course at a very affordable price, do it. take the course. I promise you will be very, very happy you spent that 12 or 15 bucks, and the link is in the description of this video. Also, if I might ask, if you liked today's podcast, if you felt it was valuable, if you're learning something, all I ask is that you hit the thumbs up button, consider subscribing to the channel. It just helps YouTube know that there's some valuable content here, helps get it out to more people. There's a lot of people that could use a lot of help, could use help and some guidance with good trading principles. And by hitting the thumbs up button, it helps YouTube get it out to more people and gets them to the channel, and hopefully from these podcasts they can learn some good things. And then lastly, and always most importantly, if you could go out and try to do something nice for someone today, I would really appreciate it. It's good for you, it's good for them. You always appreciate if someone does something nice for you. Well, do something nice for someone else. And if you could, on top of that, do something nice for an animal today, they appreciate that. I grew up with many, many animals. They were my friends growing up, and they appreciate random acts of kindness and nice, a little scratch on the head, a little pat on the butt, take them on a little walk, give them a little treat. So, I always try to finish off the podcast with try to do something nice for someone else today, for another human today, try to do something nice for an animal today. It's just good karma, and it also helps you as well. So I hope you're having a good weekend. I hope you had a good trading week. We'll see what happens this week, if we can have a continuation with this rally. Who knows? We don't know. We shouldn't try to figure it out. I mean, we can have biases and what we think is going to happen, but please, as always, just follow the price action. Create a plan, follow that plan, position size for volatility, know where your emergency stops are, know where your end of day stops are, know where your overhead resistance levels are. Consider taking partial profits as it moves up, and have a trailing stop level in place. But hope you enjoyed this podcast. Hope it's helpful for you. If you have any comments or questions, please leave them in the comments. I'll do my very best to get to them, and God willing, I will speak with you next week. It'll be interesting to see what happens this week. But thanks a lot, everyone. Take care. Have a great rest of your weekend. And on the way out here, I have to run the U.S. legal disclaimer. Take care, everyone. Hope to talk to you soon. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors, such as lack of liquidity. Thank you.